We want to bring in Lee Munson. He is founder and chief investment officer at Portfolio Asset Management, and talk about a bull. I got to tell you, Lee, you say we're going to have good times even if the market does go down another 5%, because that would get the Fed in gear to print more money, right?
Yes, if you look at the S&P 500's chart with what are called inflation break-even spreads, you can look it up what that means on the internet. But basically, when the Fed sees inflation expectations below, say, 1.5%, they tend to do things like Operation Twist. They tend to jack up the Dow Jones with reckless money printing. And so when you look at these two factors, the Fed's going to talk tomorrow. Probably nothing's going to happen. But for your stock portfolio, you need to know where the bottom is before Bernanke sort of sets up his Bernanke put. Okay. And so I think if we see the market come down another 5 or 7%, probably the Fed's going to come in there and start the money machine going along at full speed ahead.
Let me jump in here. We've got Amgen numbers. Let's get to Adam Shapiro once again. How'd they do?
Right, and the large biopharmaceutical company coming in with a beat and a beat, Liz. Earnings per share of $1.61, Street expecting $1.45. The revenue picture, $4 billion, Street expecting $3.93 billion. Of course, Bob Bradway, the former Morgan Stanley investment banker, is going to take over there as the CEO on May 23rd. But again, it's a beat and a beat in preparation for his taking over.
Let's get Mark Sebastian in on Amgen. This is a company that's sitting on $20 billion of cash. The question is, how will they deploy that cash? Investors want to know, right?
Well, obviously. But, it's hard to argue with the stock performance. It's done really, really well, and they beat again. Stocks that are touching their 52 weeks highs should beat earnings. Amgen's coming through. This is just a stock that just keeps going north, and, it's kind of the same questions with Apple, where, hey, Apple gives out a nice big dividend. Has the stock really performed well since they launched that dividend? Yeah, and then all of a sudden, look at what's kind of happening. So, there's positives and negatives of dividend issues, I think.
We have more breaking news, this time not on numbers, but Shutterfly's got some news it's coming out with. What's happening, Adam?
Right. Wall Street Journal is reporting, Liz, that Shutterfly is going to buy a Kodak gallery from Eastman Kodak. No other bidder is coming forward for the online photo service from Kodak. According to people familiar with this, Kodak is, of course, selling this. They're operating in bankruptcy. But apparently, Shutterfly had made an offer to go forward for $23.8 million. But again, they will be acquiring Kodak Gallery from Eastman Kodak. Liz?
Let us bring back Lee Munson into the picture to get his reaction on Amgen. What do you think about this drug company? They have a couple of interesting things going for them, not least of which that $20 billion mountain of cash.
I've always been a hater of healthcare. I've reluctantly owned Pfizer for the past 6 months. I think what you have to look at is, are they ever going to deploy the cash? I don't think they're going to. And I think for them to make strategic buyouts and it's not going to really hit the earnings the way you think it's going to be. I would say this is more like the Apple trade. Amgen is a biotech. It goes up. It's a momentum play. And as long as the market can sustain it, it's going to keep going up. I wouldn't be a buyer here. I would find things that can put all of their money to use.
I love it. Lee's a reluctant buyer of Pfizer. I mean, it's near at its 52-week high. It pays out a very nice dividend. Looking overall, though, Lee, quickly about the sort of macro picture here. You're an equities guy, obviously, but do you see any position at this point with somewhat of an opaque future for the next couple of months globally? Do you see any point in owning certain fixed income, and if so, what?
Absolutely. Everybody needs to have some fixed income. And I know about what's going to happen in a year or two from now when the rates are going to sock people in the gut. But if you look at mediocre to junky corporate bonds here in the U.S. I would avoid stuff with currency risk. Look for, say, junk bond bullets that only go out a few years. There's a great thing. Guggenheim has a ticker BSJF that I own that only goes out a few years, pays about 5.25. If you can find short-term, intermediate, to short-term corporate bonds. They don't have to have a great quality because the economy's okay. I think that's where you should have more of your bond portfolio in. Avoid the treasuries, avoid stuff going above 10 years, and I think that you can still have diversification, a great portfolio going forward.
All right, we have earnings from a company that has been profitable for the last 8 quarters, but the income has been falling. for the past 4. I'm talking about Aflac. The numbers are out. Adam, what are they?
Let's go right with the revenue figure. $6.2 billion. Street expecting $6.2 billion, but on the earnings per share, $1.74. It's going to be $1.74 and change. Street expecting $1.65. And David Aflac Incorporated saying that they are raising their sales outlook in Japan, but they're declaring a second quarter cash dividend as well. As soon as we get this for you, we will bring you more.
That is important, and they have significant exposure, Mark, to European financial debt. So at what point do you look at that and say this is getting a little nerve-wracking?
Well, they're actually a more interesting Japan play, I think. I think a really interesting thing to listen to is the fact that they raised their guidance in Japan. One of the major things that people have been talking about is, Japan recession, Japan slowdown. If Japan is the raising guidance in Japan, that's good for U.S., that's good for China, and backwardly good for Europe. The Europe story is such a huge story, and it's hard to hone in on a company like Aflac when you really should be looking at the entire financial sector if you want to kind of look at kind of the European play. If you think the European play is going to be a bad one, collar your stock positions. I would not be in interest rate plays. I just think I don't like owning bonds when you can go out and buy options with low volatility right now and collar your whole portfolio. I think every customer should be in Apple collars, S&P collars, and protecting their portfolio in a market like this.
Good advice.
I mean, we got the VIX below 19%. That's not exactly sky high if you consider the long-term mean is 20%.
Hey, Lee Munson, Mark Sebastian, guys, thank you very much. Mark, we're going to get back to you as soon as the S&P closes, get some comments about what's likely to happen tomorrow. Thank you, gentlemen.
Thank you so much.